I'm very pleased and honored to introduce my former partner and friend, not former friend, but former partner, Brian Brooks, who has led a fairly peripatetic life, both as most recently a regulator, the acting comptroller of the currency, where he got a lot done, as I'm sure many of you know, in the world of both banking and crypto. Was a partner, a general counsel at Coinbase, and was with a major savings and loan back in the day before, after he left O'Melveny, where he had an illustrious career, and he's still not done yet because as you can see, he's a young man. So maybe he'll share with us a little bit what his next plans are at some point, or maybe drop a hint. But that's not why he's here for. He's here to give us a keynote speech on the subject of why banks are still special, and he would be in a unique position to tell us about that. As many of you know, there was a famous paper written by Gerald Corrigan many years ago, 30 years ago, on the subject of why banks are special. And I'm sure he'll touch on that in his remarks today. But I think that subject is even more relevant and pertinent today because banks are under pressure, but still very important and special. And so I'm going to not say much more about that than to let Brian explicate that theme. Please take it away, Brian.
Thank you, Howard. But before I get started, Howard, I've got some bad news for you. Do you want to know what it is?
Well, let's start with the bad news and then go on to the good news.
Yeah, the bad news is that 1982, the year when Gerald Corrigan wrote that article, that was 40 years ago.
Oh, right.
30.
Right. Sorry.
I mean, like these are, and that becomes relevant to what I wanted to say. So first of all, thank you very much for having me. This conference has always been one of the highlights of my year for the several years that I've been going. And I hate the fact that we're doing it by Zoom. So I want a commitment from all of us that we're going to actually be in Bonnie Doon next year. We got to make that happen.
Yes, indeed.
But I'm sure that'll happen. I think normalcy is approaching faster than I had anticipated even a month ago. So hopefully that's good. Howard, here's what I wanted to talk about today, which is the idea that at a FinTech conference, my experience is that founders and VCs are incredibly expert at what it is that they're building, and they tend to be less expert at what it is that they're trying to replace or compete with. And so what I want to do today is think a little bit about what is the connective tissue between those two ideas, and why does it matter? So the reason that we picked as a topic, are banks still special, is because it turns out that the question of what banks are and what banks do isn't actually a new question in the FinTech era. It's a question that's been being asked for generations and generations. And I think it's really important for the FinTech community to be able to speak in language that bank regulators and the banks themselves understand from that history, as opposed to feeling like we are a bolt from the blue who showed up yesterday to start offering, online lending opportunities or payment processing or whatever. So with that in mind, let me just cast everybody's minds back to the early 80s, for those of you who are old enough to remember the early 80s, and remind you that up until the late 70s or so, banks really were, they were called financial institutions for a reason. That's where all of finance happened, was at banks. And everybody understood that if there was a financial activity, whatever it was going to be available at the bank and at no other place. So what that meant was if you were going to make a payment to somebody, if you were going to borrow money at interest, if you were going to place a deposit for safekeeping or custody an asset or whatever, that was always going to happen at the bank, and people got that. But in the late 70s and the early 80s, the financial landscape started to change, not primarily because of technology, although some of the early tech innovations had started to happen, but primarily because of financial innovation. So it was in the late 70s and early 80s that the first mortgage-backed security got issued, for example, and asset-backed securitizations more generally became a thing. The corporate bond market, which had been a small niche thing because banks were principally the source of credit, exploded and were able to offer things at far cheaper rates, offer loans and credit at far cheaper rates than banks were. And at the time, banks were subject to a regulation which prohibited them from paying more than a certain amount of money on their interest-bearing accounts, which meant that non-banks could offer money market funds and other kinds of things that were almost equally safe at a far higher rate of interest. So banks stopped being the depository of choice, they stopped being the lender of choice, and over time stopped being the payments processor of choice. And so in 1982, Jerry Corrigan, who headed two different Federal Reserve banks, both Minneapolis and New York, wrote an article asking, are banks special? And that article gets revisited about every 20 years when people ask the question, like we're asking today, are banks still special? And so I'll hope to knit this together into why fintechs need to care about this in a moment. But let me first tell you what it was that Jerry Corrigan, the famous Fed in Minneapolis, New York and Minneapolis Fed president, said made banks special at the time. I'm just going to basically read verbatim a handful of sentences. So the first thing he said was that only banks offered transaction accounts, and he defined that as only banks incurred liabilities payable on demand at par that are readily transferable by the owner to third parties. That was one of the special things. Second special thing, he said banks are a critical backup source of liquidity, and he said banks are the primary source of liquidity for all other classes and sizes of institutions, both financial and non-financial. Okay. And then he said the third characteristic is that banks are the transmission belt for monetary policy. And he said that role, combined with operating the payments mechanism, permit the highly efficient financial markets to function and affect the orderly end-of-day settlement. So that is the 1982 version of what makes banks special. Fast forward a little bit to 2006, immediately before the financial crisis, but also kind of before the fintech revolution really got legs. In 2006, there was a revisiting of this by a group of Fed economists, including Mark Olson, who went on to become a Fed governor at one point, who talked about the idea that each of those three things that Corrigan identified were less true in 2006 than they were in 1982. They were still weakly true, but they were less true for various reasons. And that had to do with the fact at the time that non-banks, not tech companies, but non-banks like mortgage companies and others had become way more important in various of those activities. Money funds had exploded, so the idea of savings as a uniquely bank activity had largely been reduced. Big payments processors hadn't yet come online, but non-bank lenders had become huge, especially in the mortgage space. And at that point, it was clear that the backup source of liquidity in the most important asset class in America was no longer the banking system. It was now Fannie Mae and Freddie Mac. So those things were more weakly correlated. What I want to do today is fast forward a little bit to the present day and go through these issues and contend that if what we mean by banks are the legacy financial institutions that take deposits, if we mean JP Morgan when we talk about banks, that Jerry Corrigan's three special factors are almost entirely unspecial. And that doesn't suggest that banks are important. It suggests that we really need to rethink what banking means, what the term means, in a way that is very relevant to fintechs. So if you go through these issues, okay, let's begin with the idea of banks as the transmission belt for monetary policy. One of the things that's happened, and many of you who know me know that this is a little special interest area of mine, is that it's literally no longer true that all money is created by the central bank. I mean, that was true 15 years ago, but it's not true anymore. And what I mean by that is, with the rise of crypto assets, which are now almost a $2 trillion asset class, it's now clear that there are other means of creating what many people regard as money. The total number of crypto customers in the United States is now north of 60 million people. The market cap of Bitcoin is north of $1 trillion, and the overall crypto market is more like 1.7 or 1.8 trillion dollars on a given day recently. That suggests that there are other means of disintermediating monetary policy than just using banks to transmit interest rates that the Federal Reserve sets. And if you don't believe that, look at the work that traditional tech companies are working on, which are not exactly crypto, but are really important. So look at what Facebook has done with the Libra/Diem project, where their thought is to bring a new asset to bear on their 2.5 billion user community and let that asset be the central unit of exchange inside of that gigantic quasi-nation state. So I would just argue that the transmission belt for monetary policy is nowhere near as true as it used to be. In terms of assets redeemable at par, this was 1982 when that was the case, but now we live in a world of payment cards, prepaid debit cards. Fast forward, and now we live in a world of stable coins, which with tens of billions of dollars of market cap. These are things that are repayable at par, but they're synthetic vehicles created by technology companies whose redemption features are defined by the underlying contract. And in the future, these stablecoins are not even necessarily backed by fiat dollars. They may be backed by other kinds of assets, including synthetic crypto assets. So in that environment, the idea that only banks are deposit takers, not at all clear. Money sits in other kinds of platforms. So the point I'm trying to make is that the underlying thing that made banks different from other kinds of financial companies is just not as obviously true as it used to be. And so the question is what implication that has. Does that mean that the concept of banking is not important anymore? Or does it mean that, as we've done in prior generations, we need to do a wholesale rethink of what the bank charter is about? And that's really what I wanted to focus on today, is to talk about what the bank charter is about. So many of you who know me know that I've been kind of an evangelist for a long time on the theory that bank charters should not be reserved only for those companies that take deposits. This, I believe, is something that actually has historical roots here. But the main point is that banks are a combination of 3 or 4 different core activities. And the bank charter is about the activities, not about the institutions. So if it was the case, as it was, that 20 years ago, banks were by far the predominant source of consumer lending, but today it turns out that that banking product is now primarily offered by non-bank fintechs, then my question would be, why does that activity not entitle the fintech to a bank charter if it wants to opt into the banking process? So let me just give you one data point. The data point is that as of 2019, which is the last year that I have good data for, banks' share of the consumer lending market was 28%. 28% of all consumer loans were originated by a chartered bank. But in that same year, 38% of consumer loans were issued by marketplace lenders like SoFi, Marlette, Avant, OneMain, and companies like that. That's a little bit of a head scratcher, right? The idea that more consumer loans are made outside the banking system than inside the banking system. Now, that could mean that banks are becoming increasingly irrelevant in the consumer lending market, or it could mean that the bank charter needs to follow where banking activity is going, and that might be neobanks or fintechs, not just traditional brick and mortar depository institutions. It's the same thing on the payments front, where 15 years ago, the entire business of payments processing occurred inside of the banking system. That's not true anymore. Now, as we know, hundreds of billions of dollars of payments are processed by companies like Square, PayPal, Stripe, and others. Now, we have an atavism in the payment sector, which is that those companies still need to rely on an underlying bank to connect to the Federal Reserve payment system. But that's an idea that quickly will go away. I think you've already seen it go away in Europe with the advent of open banking and e-money licensees being allowed to access the central bank payment system, the same as depositories. There's no way that in the United States we won't get there in the next few years. The only question is, will we do it fast enough to be competitive, or will we be a slow follower? All of this to say, the question of are banks still special is a question that depends on the definition of a bank in the first place. So what I want to posit is something that the OCC has asserted in litigation over this issue, and that is a bank should be conceived as anything that is engaged in one of the principal activities of financial intermediation. That means taking deposits, or it means making loans, or it means engaging in payments. And if you think about that model, what it implies is banks can still be special in all the way Corrigan posits, but only if we stop fetishizing the platform and start focusing on the activity. Now, I'd like to assert that there's a competitive dimension to this discussion as well as an economic discussion, and that is, we see in other countries regulatory regimes that are not as wedded to legacy large institutions, and that is because those countries didn't develop a modern financial system as fast as the US did, and thus don't have to protect it against competition the way that we feel we need to in this country. But this includes, countries that did actually have large institutions. So countries as disparate as Singapore and the United Kingdom have been much more on the front foot in terms of welcoming innovation into their system, with effects that are very significant. One of the effects I like to talk about is a phenomenon I refer to as the payments tax, which is the percentage of GDP that a country spends on its payment system relative to all of the other goods and services put out in the economy. What's really interesting is in the US, we spend about 2% of GDP every year on payments. That's the total sum of all interchange fees charged by the credit card networks, membership fees in the automated clearinghouse, SWIFT fees, coupled with chargebacks and other kinds of things. That amounts totally to about 2% of US GDP, which is an enormous number. Contrast that with both the UK and the EU, where the number is more like 50 basis points. So they have essentially a 4x advantage over us in terms of the friction costs of a payment system. You'd think that would be something that we would easily fix, right? As soon as we saw that on a competitive basis, we would say we've got to go and compete that away. But unfortunately, that is not the approach that we've taken in our regulatory system today, which is one reason, by the way, why you see OCC FinTech charters moving so slowly, despite the fact that 4 controllers in a row, both Democrat and Republican, have supported the concept. And that is because the principal, and this is the dirty little secret, the principal function of regulation in the US has mostly been incumbent protection. That's not totally surprising because the bank regulators are the people who grant charters. And so obviously the people who have those charters and pay the regulatory assessments, which are the way these agencies fund themselves, get a seat at the table that is a little more powerful and a little more central than people who are startups that aren't in the system yet. It's also a function, I would argue, of our system of regulatory, I won't say arbitrage anymore because you have to come to one agency for a charter, but our system of regulatory decentralization. So most of you know that in other countries, there tends to be a single financial regulator that regulates all of banking activity. In some countries, in Latin America, for example, you have a single regulator that regulates both banking and securities. But in the US, you have 3 different agencies that regulate banks, and that's before you start thinking about securities and derivatives and other kinds of products. So anybody here who's ever tried to apply for a bank charter knows that if you're seeking to get a deposit-taking bank charter, you need the approval of 3 separate agencies acting independent of each other before you can get that charter. Just because the OCC is willing to grant the charter doesn't mean the FDIC will grant deposit insurance, and you can't get the charter without deposit insurance. And even if the FDIC agrees to grant you deposit insurance, that doesn't mean the Federal Reserve will approve you for membership, even though it's very difficult to be. I mean, you can't be a national bank, and it's hard to be a state bank without Fed membership. So that's not the way they do things in England, and it's not the way they do things in Asia. And yet we continue to have this system that we've had for a long time, the most logical explanation for which is, in this country, we protect incumbents. That makes sense if you think about the history of American financial dominance. I mean, for a lot of the last 50 years, we were the most important financial center in the world. But that is much less clear than it used to be for a whole bunch of reasons, some of them having to do with the rise of China, some of them having to do with the rise of digital currencies, some of them having to do with EU unification around a single currency. But the things that we have relied on in this country to give us our advantage in the global financial system are quickly being cannibalized away by macro developments like those, and our regulatory system hasn't kept up. If anything, we continue to commit the sins of the past, because when we have chances for major financial reform, like we had with Dodd-Frank, we don't reduce the number of financial agencies. We may swap them out or rearrange deck chairs, but at the end of the day, we have an equal number of independent agencies involved in the sector, and somehow we think that's a good thing. So what I want to do is leave you with this basic thought. It's a simple thought, but it's a critical thought. The banking system in the US is special, but it doesn't mean high street depository institutions housed in Greek temple style buildings. The banking system is special because this country remains the highest output country per capita in the world, and any country like that, if it can make the system more efficient, will remain fundamental. So that means we need new ways of transmitting monetary policy that don't necessarily involve deposit takers. It means we need a faster and much cheaper payment system and all that comes with that. And it means, most fundamentally, that legacy banks need to have a lighter burden when they're innovating or when they're partnering with innovators, such as many of you, versus making it harder for innovation to plug into the existing system and modernize it. If we learn those lessons, then banks will still be special because many of you will get to be banks. But if we don't learn those lessons, and if the only companies that get to be banks are legacy institutions that existed circa 1950, the answer to the question will be very different. So Howard, it's a short statement of an important and broad principle. I'm happy to take one or two questions if you have them. But at the end of the day, the point is the business all of you are in is disrupting a system that exists to protect itself, but to do the three factors that Gerald Corrigan identified 40 years ago in a more efficient, more inclusive, more accessible, and cheaper way. That is what is necessary for banks to stay special. We need to redefine the term, and I think that's what all of you are doing every day. So I appreciate the opportunity to chat. And again, Howard, I'm happy to kick it back to you or to entertain a question or two.
Yeah, so that's tremendously good food for thought, Brian. I'm going to kick off the questions with one of mine, and then I see there's another one coming as well. So I'm sure that the forces of conservatism couch their position in terms of protecting financial stability and protecting consumers. How much credence should we give to those kind of arguments about the current system and protecting and keeping this, at least parts of that system in place?
Well, so I'd say a couple things. The world's great clash with financial stability obviously came in 2008. And what we saw in 2008 was two phenomena. One is the traditional legacy institutions didn't cover themselves in glory, right? You saw WAMU and IndyMac, two of the three biggest bank failures in history occur at that time, and those were legacy institutions that had federal charters. So I wouldn't say there's anything about legacy institutions that's necessarily safer. You could also look at Lehman and Bear as other examples of that phenomenon. But what you also saw at real scale were the institutions that were not allowed into the banking system. So the New Century Mortgages of the world blew up at far greater scale and far greater loss severity than the chartered banks did. So you've got two things going on. It's the incumbent protection feature that made the legacy system brittle, and it's the exclusionary aspect of incumbency protection, which prevented regulators from supervising the riskiest companies in the economy. And so I would argue that financial stability depends on having a more open banking system than what we have today.
Great. So there's several questions. I see Tim Fitzpatrick has asked the following question. Can you please compare FedNow with a token-based CBDC settlement and what it would mean for the banking system?
Yeah, well, so this is a great question. I'm going to argue that there's one other thing that needs to be in that list. So there's FedNow, CBDC approaches, and then there are privately issued stablecoins. All of these at some level are different mechanisms for a real-time payment system, which the United States is woefully behind on. You know, real-time payments have existed in the UK for a couple of years at this point. They exist in places as diverse as Estonia, Singapore, and now China, and yet the US somehow can't get on board. So the way I'd taxonomize those is as follows. So FedNow is really just a faster version of FedWire. It's just a faster version of settlements. All right. There's no particularly new technology there, no fundamentally new technology, but it's a way of avoiding kind of the T+3 time lag that prevents your check from clearing and being immediately deposited, or prevents me from getting access to my funds when you pay me your rent or whatever. It would be good to have FedNow, it'd be better than the status quo. But unfortunately, the Fed has told us for 5 or 6 years that we're 4 years away from FedNow. So I would tell you that 4 years is just far enough over the government horizon as to be synonymous with never. So I think that FedNow is a concept. It's not anything other than that. Footnote, and kudos to the clearinghouse, they have at least built a real-time payment system that is partially live in this country, but not fully live, and then only accessible to banks. Okay. So let's talk about CBDCs for a second. Many of you will have read the front page news today that China's e-renminbi has basically gone fully live. And so China now really has a CBDC trading in the market and being used for payments and settlements. CBDC approach is a little bit more robust than real-time payments. That means that there's actually a transacting unit of account different from the fiat dollar, right? That now can be used to transmit value back and forth across some sort of a network. It could be a blockchain or it could be something else. So it has the features of FedNow, but it also has the features of a token. versus what we normally think of as a Fed issued dollar that is held in reserve somewhere in some physical location. That's better than FedNow, I think, but it also presents certain risks. And if you read the article about the ERMB this morning, you'll see what some of those risks are. Namely, do you want the federal government in any given political administration to decide whether they want to turn you off, halt your payments, decree that certain people can't receive payments or can't send them? And if you think that's fantasy, all you need to do is look at the events of the last couple of years where various financial institutions have decided that they won't lend to certain sectors of the economy. Various payments companies decided in the last couple of months that they won't transmit payment to certain political candidates whose views are thought to be anathema, or they won't process the payments of people who attended the Capitol protests. I don't mean the riot, that was a different group of people, but the much larger group of people who didn't go storm the Capitol, but showed up and weren't able to buy plane tickets home for various reasons. This is sort of and then they came for me moment. So the issue with having something like this is there's no cash anymore in that society. You can't pay for things anonymously or privately. Now the government will not only know what you're doing, but will in fact be able to control what you're allowed to do. And so that is why a lot of libertarians are concerned about CBDCs, although it has a lot of efficiency advantages. And then you have my favorite approach, which is stablecoins. Stablecoins are blockchain-based payments instruments and units of account that are subject to government rules around price stability and collateral and audit, rules that, among others, I helped put in place at the OCC last year, which would have all of the features of a CBDC, but without the government control and surveillance. I would argue that's more akin to the economy we know today, with efficiency advantages, but without giving up the innovation of the private sector or the privacy of a non-government controlled system. And those kinds of tokens in the US are scaling rapidly. And Howard, as you know, there are multiple tokens with more than $10 billion of market cap today from basically a standing start a year ago. So those are the three alternatives: FedNow, CBDC, and stablecoins.
Great. Another question, I'm going to go through these quickly, is from our former partner, Larry Tu, who's online. And you can follow up with this directly if you like, Larry, but what are the odds that we will find a way to rationalize our duplicative regulatory structure? And how much does it matter if we cannot?
Well, so first of all, Larry is one of my favorite voices from the past. Larry was a young partner at O'Melveny when I was an associate at the very beginning of my career, and he is now a legend. So Larry, the idea that you're asking me a question is like one of those career moments for me, to be honest. But what I would say is you get basically a once in a generation opportunity to reform the structure. And so I doubt that in our lifetime, we're going to see a real opportunity to do that kind of reform. I mean, you had Dodd-Frank, right, in 2010. Before that, you had, Graham Leach Bliley in 1999. That was shockingly fast because before that, the last foundational change was, back in really in the 70s and 80s. So I would say it's not likely. Having said that, I'll tell you what I think it would look like. And I've talked about this a fair amount before. I think what makes sense is to think of one agency as in charge of chartering and supervising banks. That would be the OCC. One agency in charge of resolutions and deposit insurance. That would be the FDIC. And a third agency in charge of monetary policy. That would be the Federal Reserve. Weirdly, right now, however, they all are up in each other's business about everything. So like the OCC and the Fed both have to agree on capital rules. And the OCC, the FDIC, and the Fed all engage in supervision, sometimes of the same institutions at the same time. And the OCC gets to be the closer of banks, but the FDIC gets to be the conservator of failed banks. So what you have right now is not just multiple agencies, but agencies that have overlapping turf, which prevents any one of those agencies from acting quickly. And that's why it's not a great environment for innovation. That's always been my proposal for how to rationalize this, but my guess is that's going to be the next generation that gets a chance to do that.
Great. Last question before we have to go. Winston Ma asked the following question: how will DeFi developments on blockchain change the status of the banking industry?
Well, so Winston, I don't know if that's a teaser question or a credulous question, but so I addressed this in the last op-ed I wrote when I was still running the OCC, an op-ed in the Financial Times called "Get Ready for Self-Driving Banks." And my suggestion was, look, most of existing bank regulation in this country focuses on regulating bankers' conduct, but not banks themselves. So if you look at what the Code of Federal Regulations is in 12 CFR, it's almost all about what individuals can form a bank, what the required officers are at banks, what kind of committee you have to approve your risk management policy. And it's all about people. At the end of the day, what DeFi is all about is saying, you know what, if you wanted a faster system that isn't capable of like intentional discrimination and that is able to allocate credit more efficiently and not make mistakes, you'd want an algorithmic banking system. You wouldn't want a bunch of guys sitting around a table in credit committee doing that. You'd want the computer software to do it, and you'd want it to be open source software so that errors such as they are can be innovated by the community of developers over time. That's what you'd want. And so the question I asked in that is, so if we did that, if we started having DeFi at scale, what would you call that thing? What would the legal authority for that thing to function be, if any? And what would the ability of regulators be to ensure that the software itself was not committing fraud by describing something as one thing and offering it as something else or whatever? And my thinking was, look, you could supervise that probably more easily than you could supervise a traditional bank. Because if it's just open source software, then the government could plug in and it could look at the code. And if it saw code that was systematically resulting in, for example, black people paying higher prices than white people, it could correct the code, which after all is open source. So I think in a funny way, DeFi is a logical evolution of what banking will become. It's the only true iteration of peer-to-peer in the world of credit allocation. And it's something that solves a lot of problems, which is the problem of human failings, human, negligence, human graft, all of those motivational things. So I'm a big believer that DeFi is the ultimate killer app of crypto. It's in its early stages, but it has doubled in each of its last 6-month cycles. And the challenge is, can bank regulators do what I outlined in the op-ed? So again, it's get ready for self-driving banks in the Financial Times in mid-January of this year.
Great. That was a good article. I think we've reached the end of our time, Brian. I hate to end this session because it's been so interesting. Are you going to drop a hint on what you're doing next, Brian, or is you going to keep that a secret to us?
Well, I expect to be making a significant announcement on either March, is it April? Either April 16th or 19th. I'll be testifying before the House Financial Services Committee on the 15th, so it will not be before that.
Okay, well, I'll put that in my calendar. Terrific. Thank you so much for joining us today, Brian. It's always great to hear from you, hear your remarks, your thoughts.
Thank you for having me next year in Santa Cruz.
Absolutely. Thanks again.